One of the biggest events this year is China's reopening. This is sure to have an impact on everyone, regardless of where you live. How? That is what you're about to find out in this video. China was closed off from the world for nearly 3 years, a period of 1,016 days to be precise, with the zero COVID policy being a new social and economic experiment that just ended this year on the 8th of January. As a result, the story of China's reopening has rapidly become a crucial trading theme in the emerging markets and the world in general. Would this bode well for global investors? Or will it increase the twinge of the already tiring global recession? If you are new to the channel, remember to subscribe so you can always get in-depth analysis and updates related to the economy and personal finance. Here are 10 ways China's reopening would affect you. Number 1. Inflation. A major effect the end of the zero COVID policy could bring in the long run is inflation. It's no news that the main obstacle to economic growth in other economies is the monetary policy put in place to control inflation by increasing interest rates. With this, central banks around the world may be left with no choice but to tighten monetary policy if China's reopening leads to an unsustainable increase in global demand prices. I'm sure you can already tell how this would go. Higher inflation and interest rates, rather than boosting economic growth. Number 2. Increased trade and investment. Increased trade and investment are one of the key ways that China's reopening could affect you and businesses globally. As companies increase their exports to China, they may require additional workers to meet the demand for their products. It was estimated that up to 100,000 foreign individuals, including teachers and others supporting the international workforce, were waiting to return to Shanghai alone. You should also expect increased imports from China. Aside from this, the relaxation of cross-border travel restrictions is a boon for multinational companies' operations and investments. Executives can once again travel between headquarters in China, leading to new deals and projects. However, there may still be temporary disruptions in manufacturing and supply chains as epidemiologists predict the first wave of an unprecedented surge in infections will reach its peak in the next few months and be under control by June. You should therefore prepare for potential disruptions and implement measures to minimize risk until around mid-year. But on the bright side, economists estimate that China's GDP in the first quarter of 2024 could see a 10% increase compared to the difficult first quarter of 2023. Going by this prediction, you can anticipate that the strong rebound in the world's second-largest economy has the potential to drive a significant portion of global growth in the near future. Number 3. Stock prices. Expect China's reopening to have a huge impact on the stock market, because directly or indirectly, the Chinese market would affect the supply of raw materials and supply of competitive goods. The manufacturing and retail industries would be most impacted by the full re-entry of China into the global supply chain. We are already seeing a positive response from the markets because the prices of raw materials are gradually subsiding. This effect would start from the Asian market, and we can see it already. The Asian markets are kicking off with a bull run, as we can see in the MSCI Asia-Pacific Index, which has since rallied by 24% so far this year. Tech companies may be the biggest beneficiaries. There has been a major computer chip shortage because of the Chinese manufacturers that could not meet the demands in Europe and the US. But things would change now with the tech companies getting back to full production. The US is China's largest trading partner, and the two countries have a lot of businesses that are relying on each other. Many US companies have their manufacturing arm in China, so this is definitely a plus for such companies. When these businesses are able to meet their demand obligations, we can be sure of seeing the impact in their stocks, which would also have a ripple effect on the investing temperature we would see in the affected markets. On one hand, it promises to boost consumer demand, which would drive up stocks, improve corporate cash flows, and boost trade volumes. On the other hand, this could also put pressure on the yuan and delay a potential interest rate hike by the Federal Reserve. Added to this is the expectation that a rise in demand and the country's robust economic growth may also lead to inflation, which will reduce real yields in the bond market. But despite these mixed views, the recent zero-COVID policy changes have already had a good impact on the market. The projections of a 4.8% growth rate in 2023 have also spilled over to other emerging markets, boosting the Thai baht, South African rand, and Brazilian stocks, in contrast to the US and the European Union, which are expected to grow at a much slower pace at rates of 0.4% and 0.1% respectively. Number 4. Currency fluctuations. Currency fluctuations are another effect to watch out for. You should expect fluctuations in the exchange rates of various currencies, which could in turn influence the cost of goods and services and affect the competitiveness of exports and imports between countries. If you own a business, you should expect currency fluctuations to have an effect on your bottom line. Take for instance if the value of your company's home currency devalues relative to the Chinese yuan. The cost of your exports to China could increase, reducing your competitiveness in the Chinese market, and vice versa. And when it comes to individuals, the changes could affect the cost of travel and other international transactions. Although experts predict the lifting of the lockdown could result in an increased volatility in currency markets, particularly in the short term, there's however no correct estimate of how much an impact you should expect, as this would depend on many factors, such as changes in demand for certain goods and services, changes in interest rates, etc. Number 5. Increased tourism. The Chinese tourist industry took a huge hit during the pandemic, and they accounted for almost 20% of the world's international tourism spending, equaling $255 billion in 2019. However, there's every reason to be optimistic as early indicators suggest they're ready to return. In fact, the travel platform Ctrip saw a tenfold increase in searches for top destinations abroad just within 30 minutes of the news about relaxed quarantine rules. Hong Kong and Thailand are expected to be the first to benefit, as they're estimated to see a boost to their GDP by 8% and 3% respectively, according to Goldman Sachs predictions. Other sectors that rely on travel, such as aviation, hotels, and retail, are also expected to reap the rewards. So if you are actively involved in any of these areas, then you can start expecting those calls and bookings. Number 6. Easing of political tension. While you may think the political tension between the United States and China doesn't directly affect you, it has created a negative outlook for the global economy. The zero-COVID policy, which restricted cross-border travel, further affected the important interpersonal exchange between both nations, which is crucial for building trust and understanding. Thankfully, with the reopening comes a chance to resume face-to-face interactions between officials, academics, business people, and students from both countries. This type of interaction is especially important for future decision-makers, as a recent survey showed that those with experience studying or traveling in the United States have a more favorable view of the country. With this, we just may be seeing a stretch of a friendly hand very soon between the two countries. Number 7. Technological advancements. Technological advancements play a critical role in shaping the future and will be greatly influenced by China's reopening. One major way this would come to be is by increased global competition for technology and innovation. With more investment, and of course the eased quarantine regulations, Chinese companies could develop new and improved products and services, which could put pressure on businesses in other countries to innovate and improve their offerings. Take for instance the innovation spurred by the COVID-19 pandemic that prompted a rapid advancement in China's e-commerce platforms. Without the crisis, it's unlikely that China's tech giants would have progressed this quickly or received as much support from the government. Additionally, the widespread adoption of these innovations by society may not have happened. And now that there's free movement and people can gather again, however minimal, there's no telling what China would start cooking. Number 8. Increased environmental impacts. With China being a significant contributor to global greenhouse gas emissions, generating 27% of global carbon dioxide and a third of the world's greenhouse gases, its rebound will likely result in increased environmental pollution as economic activity and transportation pick up. This would therefore increase the number of dangerous gases released and ultimately bring the progress we've made so far on mitigating climate change to zero. Number 9. The oil and gas sector. Goldman Sachs predicts that China's quick recovery could raise the price of Brent crude oil to $100 per barrel, an increase of 25% from current prices, most especially as the country is responsible for buying about 1/5 of the world's oil. And as demand continues to rise, it is expected to more than make up for the declining consumption in Europe and the United States, which is slowing down their economies. This would then present a new challenge in controlling inflation, with higher energy costs adding to the difficulties. And when it comes to liquid natural gas, the robust rebound in China is likely to lead to an increased competition for its imports. This is like a warning to Europe, as it was easier and more cost-effective for it to refill its storage tanks in 2022 when China wasn't in the picture. We can therefore only hope that the effects of the possible price increase aren't too adverse. Number 10. Consumer habits. The recovery of the Chinese economy is also poised to have a massive influence on the global stage in 2023. This impact may not, however, be immediate, as the first quarter is predicted to come with a temporary contraction in the economy, especially if the government decides to take additional measures to curb the spread of the virus by sealing off certain towns. But this would only be a temporary setback. The rebound, which is expected to come soon after, will see economic activity picking up pace and driving an increase in the demands for goods, services, and commodities. You can expect that this new surge will be felt across a wide range of industries and countries, from bustling tourist destinations like the beaches of Thailand to major corporations such as Apple and Tesla, to central banks worldwide. More positive influences are also expected to be seen, with Beijing shifting to a more pro-growth economic policy by supporting the private sector, domestic consumption, real estate, and big tech, which are crucial drivers of economic growth. Despite the feeling of hope this world-changing news brings, particularly the allayed fears of the possibility of a global recession and the prediction of increased interest rates, you can only keep your fingers crossed to watch how things play out. If you enjoyed this video, give it a like and subscribe to the channel, and I will see you soon in our next video.